Thank you. So we're gonna now go to the next paper, coordinated engagement, and we have Chi Lee, who's gonna present the paper.
Thank you so much for the organizer to include our paper in this program. And so this project is co-authored with Eroy Dimson and Osan Karakas, also at the Cambridge Judge Business School. And I'm from London School of Economics. So if you have paid attention, I'm sure everybody here is paying attention to responsible investment. And we recently have noticed there's a lot of coordinated efforts among financial institutions in responsible investing. Just to give you an example, recently BlackRock signed up to join Climate Action 100 Plus. And there are numerous other investor initiations trying to coordinate the efforts from different institutions to make them responsible owners. So with this paper, we are trying to focus on one of the largest international investor initiation, PRI, Principles for Responsible Investment. So PRI was founded in 2006 and supported by United Nations. And it is a leading network for investors committed to responsible ownership and long-term sustainable returns. So by September 2019, that's when we collected data. PRI has more than 2,500 signatories from 67 countries, and total assets under management is more than $80 trillion. So PRI is by far the largest investor coalition in the world that's focused on responsible investment. And this is just to give you our brief view about where the distribution of PRI signatories, which is the focus of this study. And so to give you some examples of signatories that we study in this paper, PRI actually classified their signatories into three categories: investment managers, asset owners, and service providers. And the PRI charged a fixed annual fee from each signatory or each investor. And the fees are different for investment managers and asset owners and service providers. I think the highest fees are charged by investment managers. And as you can see from this slide, these are really one of the biggest names in the world, the biggest asset managers and asset owners. And the PRI, if you want to become a signatory of PRI, you have to abide to 6 principles. And number 2 principle of PRI is that we will be active owners, and we are going to incorporate ESG issues into our ownership policies and practices. So this principle has been practiced by and required by more than 85 of the signatories today. And one thing that PRI encourages is collaborative engagements. That is the focus of the study I'm presenting today. And although there has been a lot of media attention on the collaborative engagement among institutional investors, there's very little evidence on this. So that's why we study this research. And this is just to give you some sense on what the collaboration looks like on PRI. So once you sign up as PRI signatory, you'd be able to log into their website, their platform. And and you can see those ongoing projects. So these are the projects that each signatory are able to sign in to become part of the team. So this is called a collaborative platform, engagement platform. So there are the various different projects going on, and the majority of those projects are related to social and environmental issues. As you can see, this is about child labor. And so this study, we are trying to understand the incentives and disincentives for signatories of PRI try to join this collaborative platform. So from economic perspective, there are benefits and costs associated with collaboration. So we think the biggest benefits of collaboration among investors to engage together with target firms is the pooling of resources. So because your resources are pooled together, you have higher shareholdings in target firm. It means you have more voting power. So especially for medium-sized investment firms that are interested in making an impact in the target firm, but are limited by the actual shares they hold in the target firm. By putting their resources together, they will have louder voice. And another benefit of collaboration is risk sharing. You are able to share risk across all the investors that join the collaboration. And then you also get information and cost sharing. It is very costly to identify the potential targets to engage in. And it's also very costly through the engagement process because you have to talk with the management and meet the board of directors. And some of those target firms are all around the world. Therefore, by having a platform, a team of investors that collaborate together, you can actually borrow the local expertise of investors that locate in the same region, same country as a target firm, and you can borrow their local expertise. They would have access to local resources. They would have relations with local policymakers, and they would also have relations with local companies. So information cost sharing is also one big benefit of collaboration among investors when they try to do the engagement with target firm. And of course, there are also costs. The biggest cost, economic cost, is free riding problem. So the cost is borne by all the investors are engaging with the firm, but the benefits are shared. If there's any benefits, they are shared by all the shareholders of the target firm. And there's also potential competition, especially among asset owners who are competing for fund flows. And if they all engage together, there's potential competition among them for reputation as well. And also coordination is difficult and time consuming, especially when you are engaging with a panel of different firms across different countries. And all the investors are also from different countries and regions. Coordination extremely time consuming and difficult. And also different investors, they may have different priorities. So which make it even more difficult to coordinate. And lastly is legal concerns. In certain countries, for example, in the US, there are regulatory barriers for investors to talk to each other. They are called the counterparty concerns. So they are, after Reg FD, it is extremely difficult for investors to talk with each other. And we argue that PRI as a third-party coordinator, it can actually substantially exploit advantages and overcome the challenges of coordinated engagement. So what PRI is doing is to provide a collaborative platform, as I showed you a few slides earlier, that they provide this platform on their website where the investors can go and sign up to join their collaborative platform. And so PRI provided us with granular and comprehensive data of 31 of their collaborative projects. And each engagement, what we call engagement, is each firm, target firm under each project. And each engagement is supported by various different asset owners and investment managers and service providers. And so this allows us to analyze different incentives of different types of investors, different size of investors to engage with target firm. And the data set is global in a way that both the target firms and the investors are from different countries within each project. And there's a dated record for each engagement. So we can observe the starting date as well as the completion date of each engagement. And we can observe the success of each engagement. And the data is provided by PRI. This covers 31 PRI coordinated projects over 2007 and 2017. And they broadly cover 4 different areas: environmental, social, governance, and UNGC. This is United Nations Global Compact. And even the governance, it is not traditional corporate governance. The governance mostly focuses on the diversity of the board. So in total, we have 1,654 dialogues, or what we call engagements, with target firms. So in a way that we have 31 projects. So within each project, there are average 50 different target firms across different countries. And there are in total 960 unique public listed firms across 63 countries as targets. And if we look at the investors that engage with those companies, there are in total 224 unique investors from 24 countries. And their aggregate asset under management is 23 trillion, and with an average AUM of 112 billion. And they represent asset owners, investment managers, service providers. So the research question that's in this paper we are trying to ask is, what companies are engaged Are they from particular countries, industries, or types? And then we are trying to understand what types of investors are more likely to engage and to lead those collaborative engagements. And then we are trying to dig deeper. We are trying to understand the economic incentives underlying each engagement and each decision and to lead collaborative engagement. Next one, we are trying to understand what factors would increase, would the likelihood of success would be most effective for the collaborative engagement. Lastly, we are trying to understand what would be the impact on the target firm for those collaborative engagements. First, just to briefly go through which firms are targeted. We find that most engaged countries are from US, UK, France, and Japan, not surprisingly because these represented the largest capital markets in the world. And if you will look at industries, they are mostly manufacturing, infrastructure, wholesale, and retail. These industries are either mostly subject to environmental, social issues, or they are mostly consumer facing. And then one interesting we find is when we look at deeper, looking at the target firm's characteristics, we find that the firms that are targeted by those collaborative engagements are the largest firms in the respective industry and in the respective country. And they have low growth, they are mature firms. And if we look at their ESG ratings, they actually have higher ESG ratings compared with their industry country peers. So this is consistent with the PRI's very proactive targeting strategy. They are trying to target the bellwether firms. They, instead of reacting to certain issues reactively, they proactively target the issues that could potentially arise in the future. So they are first trying to target the bellwether firms in the respective industry and country, and to set the industry standards for that country and industry. And then we also look at the economic incentive. We find that the target firms have higher percentage of owner equity held by the engaging investors. So this reflects the investor scale and voice when they have higher holdings in the target and they have a larger voice and more voting power. And then the second, that's in my opinion, most interesting part of the paper is that we are trying to understand that the incentives for institutions to engage, to join the collaborative engagement. So in total, PRI has more than 1,700 signatories at the time of this analysis. Today, it's even higher. And the PRI signatories includes all the names, the biggest names in the world, the asset managers. And among these 1,700 signatories, only 224 ever joined the collaborative engagement. And only 90 of them ever became the lead investor of this engagement. So we are trying to understand who are these 224 that engage and join the collaborating engagement. So this is analysis. This is a signatory level analysis. Basically, only one investor show up only once in this regression. And we try to analyze two incentives. One is to ever become involved, which means ever engage at least once to join the collaborative engagement platform. The second, column 3 and 4, we are trying to understand who are the investors, 19 investors who ever become a lead investor. So we are analyzing the entire 1,700, but because some of those, around 18 of them, about 200 of them are service providers. For service providers, we cannot get the information on their AUM, so we exclude service providers from this analysis. So this analysis only includes asset managers and asset owners. And we find that the PRI's founding signatories, PRI was founded in 2006. At that time, there were about 20 asset managers and asset owners become the founding signatory. And they are more likely to engage, which is not surprising since they founded PRI. And we find that the longer they have been sign up as PRI signatory, the more likely they are active in this collaborative engagement platform. And the most interesting thing is the size. Size is measured by AUM. We also have alternative analysis where we measure size by the number of staff of the asset owner and asset manager. We find the same result. We find the inverse U-shape between the probability of joining the collaborative platform and the size of the investor. So this suggests that when you are too big, you don't want to join the collaborative engagement. For example, BlackRock, the biggest three names, BlackRock, State Street, and Vanguard, they never joined the collaborative engagement. And we chatted with PRI. This is consistent with their observation. They argue that because the largest ones, they don't need to join the collaborative engagement. They can engage by themselves because they have very high holdings in the target firm. They don't need to pool their resources. So they are not interested in collaborative engagement. And that's why the largest ones, they are not part of this collaboration. And the smallest ones also not part, because the smallest ones, they are really limited by their resources. So even if you can team up with others, this also requires you to commit significant amount of resources, to commit time to join. You have to be active with the engagement in order to be part of the collaboration. So we find the inverse U-shape. Only the median size of investors will join the collaborative engagement. And we also find the last two columns, the signatory has formal process of engagement by internal staff, and number of collaborative initiatives participated outside PRI. These are also highly correlated, suggesting that the investor needs to have the resources, especially after we control for those two aspects of the investor resources. We no longer find size to matter. It suggests that the size is really capturing the resources and the interest of the manager, of the investor. So you need to have internal resources committed in order to join part of the collaborative engagement. And then we are trying to analyze that among those 220 those investors that join the collaborative engagement, and who are more likely to become a leader. And we find that size doesn't really matter anymore to become a leader. And because to become a leader, you actually, the minimum resources requirement is already required. So because the smallest ones, they will not join anyway. So to become a leader, the size does not really matter anymore. And what we find interesting is the pension funds. When the signatory is pension, they are less likely to join. So our argument is that pension, this is also consistent with PRI's observation, that pension funds, they are asset owners, and they are less interested about their reputation. That they don't need to do things to attract the fund flow. Therefore, they are less likely to become a leader to lead the engagement. And again, the investor needs to have internal resources to commit it to engagement in order to become part of the leader. And this is a signatory level analysis. So next, we are trying to understand that the economic incentives behind each engagement. So each engagement has a very interesting structure. On average, each engagement has 26 signatories, and with 15 investment managers, 10 asset owners, and 1 service providers. And 30% of those investors are pension plans, and with 27 PRI funding signatories. And 8% of the investors are domestic. Domestic is defined in the following. So when the investor's headquarters is located in the same country as the target firm's headquarters, it's defined as domestic investor. 8% of 26 signatories are domestic. And we also find that PRI, they had a learning curve. So they had 31 projects. Over the years, they learned that it's probably more effective when you actually divide the investors into 2 tiers. They identify one or multiple investors as lead investors to lead the dialogue, and the rest identify them as supporting signatory, as supporting investors. So about half of the projects, about 400 engagements out of 1,600, have 2-tier engagement strategy. And if you look at the lead, for the ones with the lead investor, about 52% of them are the domestic investors. So next step for us to do is to understand, if we hold the investor characteristic constant, what would drive the investor's decision to engage, lead, and support? And this is analysis. This is a signatory engagement level analysis. So in the first 2 columns, we are trying to understand what drives each signatory to engage with a particular target, holding constant the signatory type and size. So we are including the signatory fixed effects. We also include target fixed effects and project fixed effects. So the purpose here is really trying to tease out the economic incentive underlying each specific target, each specific engagement. So we find that when the target is domestic, the investor, the signatory, is more likely to engage. And we also find that when the investor is, or the signatory already have some other ongoing projects, they are less likely to engage. So this indicates that engagement is quite time consuming and resource consuming. Therefore, they are they have less capability to engage if they are already involved with other engagements. And the column 3, we are trying to understand. So suppose with the investor has already decided to join the engagement, and the PRI has required those among all these investors, there need to be a lead. What is the incentive for investor to become a lead investor in this engagement? And we are trying to understand this. The most important determining factor to become a lead is if the target is domestic. When the target is from the same country as the investor himself, he's more likely to become a lead. And also the economic incentive play a very important role. Is the signatory's exposure to target and signatory's holding target. So exposure is defined that the holdings, the value of the holdings, the target firm divided by the investor's total portfolio, which means how important the target is in the signatory's portfolio. And the signatory holding is a percentage of the signatory's shares in the target firm's total shares outstanding. So it means that when the target is more important to the signatory, to the investor, and when the holdings in the target is higher and the signatory has a larger voting power, they are more likely to become a lead. And again, when there's other ongoing projects, when the investor is involved and investor is less likely because of resource constraints, less likely to lead. So lastly, we are trying to understand. So suppose that we already have the lead investor set up for this engagement. So what are the incentives for the other investor to join as supporting investor? That is column 4. And we are trying to understand whether the characteristic of the lead also plays a role to attract the investor to become a support. So after the lead has determined whether target is domestic no longer matters. So in fact, we find what matters is whether the lead is from the same country. Whether the lead is from the same country as a target. When the lead is domestic, other investors are more likely to join as a supporting investor. And another thing is when the lead is a pension fund, actually the other supporting investors are less likely to join. They don't like pension fund to become the lead. And later we are going to show you why they don't like pension fund to become the lead. Then the next step, after understanding the economic determinants of joining the engagement, we are trying to look at the success. What determines success? What type of engagement structure determines the success? And PRI provide the success data for us. They evaluate for about 1,000 engagements out of 1,600. And the success is mostly evaluated by look at the performance scores in the pre and post engagement period. And the success rate, there's a large variation. The success rate could range anything from 0% to 100%, depending on the project. And the average success rate across engagement is about 52%. And this is a analysis. The left-hand side variable is the probability of success. And the right-hand side variable, we have controls for the target firm characteristics. And here I'm showing you basically the engagement structure. We are most interested in what type of engagement structure are most likely to lead to success. So the one most striking thing we find is what I highlighted, is engagement has lead investor, is whether the engagement has two-tier structure. And it shows that when the engagement has a lead investor, the success is increased by 26 to 37%, depending on the model specification. It's a really substantial increase when your engagement has a two-tier engagement structure. We also try to look at the influence of the investor group by looking at their total holding in the target firm, their total size, which is measuring their potential investment power in the target firm. As we also measure what's the percentage of the investors have internal resources committed to engagement. And we find that the more influential the leading team, the investor team is, the engagement team is, the success is more likely. Another thing we find is when the investor group has larger pension plan and the higher percentage of pension plans, the success is more likely. And when the pension plans ranges from 0% to 100%, the success rate can be elevated by 50%. Half the success rate increases by 50%. And the last three columns we are analyzing, conditioning on the engagement already has a lead investor. What are the characteristics of lead investor that would determine success? Again, we find that when the lead investor and supporting investor have higher influence measured by holding in the target firm and higher AUM, the success is more likely. One interesting thing is when the engagement has pension plan as lead, the success is lower. So try to recall earlier in the last slide, I showed you that the supporting investors don't like their lead investor to be pension, which shows that they are actually rational. That when the pension plan has a lead investor, the success rate is much lower. And we also find that when the lead investor is domestic, means that the lead investor is from the same country as a target firm, the success rate is also much higher. So to sum up that way, we find that the conditional on lead, the success rate is much higher when the lead is domestic, and the success rate is much lower when the lead is pension plan. And we also find when the PRI funding signatories was lead, the success rate is quite low, is lower. And we also find that the pension plans, when pension plans are supporting investors, the success rate is higher. So really it comes down that pension plans are important, but only important when they are supporting investors, but not leading investors. Probably because pension plans, they are less concerned about reputational concerns. They probably also have less resources committed for the engagement. And lastly, we are trying to understand the impacts on the target firm of engagement. And we contrast the success engagements with unsuccessful ones. And we also contrast engagements with and without lead. Here we take out the engagements with and without lead because, as I mentioned earlier, the two-tier engagement structure is relatively exogenous to the target firm and to the investor because it's exogenous imposed by PRI's structure of leading those collaborative engagements. Therefore, we are trying to, and this is also one of the biggest factors that determine success. That's why we are trying to compare engagements with and without lead. And we look at target firms' long-term stock performance, target firms' accounting performance, and the investors' holdings in the target firm. And this slide shows the stock performance. We look at the pre-engagement. We take 2 years before the engagement, initiation of the engagement, and 3 years after the engagement. The reason is because it takes on average 2 years for the engagement to conclude. And we contrast so the left column shows you the subsample with lead with success, and the success and with lead. And the second column shows you the subsample without lead and unsuccessful, or unsuccessful and without lead. And the numbers in bold color, in bolded, they are the ones shows that we compare the coefficients across the subsamples. And when they are bold means they are statistically different, the coefficients. And this is the equivalent to diff in diff analysis. Basically, we contrast the subsample with lead and without lead, and contrast the post period with the pre-period, and shows that when the engagements have the lead investor, the abnormal return, annualized abnormal return, buy and hold return, and annual cumulative abnormal returns are higher in the post-engagement area in the first 3 years after engagement. And also the abnormal return is also higher for the subsample for the successful engagements relative to the unsuccessful engagements. And on the other hand, if you look at the subsample without success, unsuccessful, and without lead, the reaction is 0. means that even if those engagements are unsuccessful, it does not harm shareholder value. When they are successful and when they have lead, they increase shareholder value. And when they are not successful, they do not harm shareholder value. And then we
You
look at the
you have to conclude, please. Sorry.
Okay. So just to conclude that we find there's abnormal returns and abnormal accounting performance and sales growth associated with target firm, and we do not find the shareholdings change much, especially not for the lead investor in the target. And so basically, to sum up, so we find that the engagement practices associated with success when they are two-tier strategy, and when the lead, when the engagement team, they are influential. And we also find that when the supporting investors, they are pension plans with higher influence, they are more likely to lead to success. Thank you.
Excellent. Thank you very much. So we have Francisco Ursula to discuss the paper.
Yes. Hi, everyone. Let me start. So I love the paper. The paper is very like a comprehensive overview of these coordinated engagements. It's a great intro to the literature. This is extremely important, right? And goes like one step at a time. So which companies are targets? So like how are the engagements organized? What explains is driving their success, and then what happens to firm characteristics afterwards, right? So the paper, like, let me emphasize this is super important because the topic is so important, right? And it's like a roadmap on understanding what is driving successful engagements in these environmental and society issues. I have a few comments, like some that were actually things that she said, but let me see if I can contribute a bit to it. The first one, that it's very easy to be, I think, skeptical with this literature in general, right? And so some results are very interesting because they show you, like, especially the result on the success of engagements. It shows that the success depends not on target characteristics, it depends on the characteristics of the coalition. And this is very, this is like anti-cynicism um, result, right? Because you would tend to think that this is all, and kind of all the paper is driven by omitted variable bias. So this kind of, I think this is kind of the concern with this paper, this to which extent you have a lot of omitted variable bias, right? So I don't think, I hope the referees are not hammering you on that particular issue, but this is one thing that I was like, wow, this is, at least is pushing that what matters is the coalition rather than the targets themselves. I found that very interesting. Something also that you mentioned, that she mentioned, is that the companies that are targeted are the bellwethers, right? So the most important companies in the industry. And this obviously leaves a question, opens up the question, well, what happens to the companies that are in that industry that are not targeted? So you can think two ways, right? I don't know which one prevails, and I think you have the data. The data is very easy to collect. Would be like let's say that there's mining and everyone is being targeted because you have to follow some mining practices, but I'm not being targeted. Do I take advantage of the situation? And there's like a short-term abnormal return because I'm just destroying as much Amazon or mines or whatever you want, or eventually there are some positive spillovers of not of because the level of the industry goes up. I think this is a very important question. I think this is very easy to answer also, but I don't know if you thought about it or you're thinking about it, but for me this is very obvious because at the end of the day, you want that the whole industry improves its like environmental issues rather than just a few targets, and that's not really what you're doing now, right? You're only now looking at the targets. The one other issue is that at the end of the paper they show that, well, what happens with, and she showed it, what happens with returns and ROA and profitability and so on and so forth, sales growth. And this is, and she said it like this is really like a different diff, right? You have before or after, and you have successful and unsuccessful. I mean, these are all non-random events, right? So it would help a lot if you can have like a plot to see that the characteristics of the successful and the unsuccessful before the event are more or less similar. Because otherwise, again, this is going to be very difficult to believe in this type of result or this type of analysis. That so if they are completely different to begin with, right? Now, like the standard in different diffs is that you don't only want parallel trends, is that you also want that before the 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 the, the treatment, that there are really, that there are no significant differences between treated and non-treated firms, right? So if you just had one figure that would show that the differences before treatment are not so important, it would lend a lot of credibility to your to the results, right? And last one, I don't. It feels like you use. I mean, I'm not an expert on this, right? But you, in the paper, you say that well, there are many other organizations that are similar to PRI, but this is the largest, and I get that, and they gave you the data, but it feels a bit like a PRI instruction manual. Would be interesting if you can broaden up the paper a bit to see what do the others do and whether so like kind of an external validity of your results to the rest of the non-PRI institutions that also help investors to coordinate. You mentioned a few. So this should be very easy to do, but I didn't see it in the paper. And you don't really want that it becomes an instruction manual for PRI. You want that it's kind of has a bit of a broader appeal. But yeah, I also understand that they gave you the data, right? So there is a bit of a balance there. And I mean, so those are my points. Of the paper is extremely polished, so I was a bit intimidated to begin with because it's like, how can I add something to this, right? But I think these are all small issues and very easy to implement. And overall, I mean, I like the paper a lot. I learn a lot from it. This is not only important academically, this is obviously important in terms of global warming and all the other issues highlighted by the UN. So it's a great read, and I hope that everyone really goes through it because I learned a lot. So thank you.
Okay, thank you, Francisco. Chi, would you like to quickly respond? And then we have one question from the audience.
Yes. Thank you so much, Francisco, for the comments. And indeed, I think the most interesting that we find in this paper, uniqueness about this paper, is the correlation characteristic. We are not particularly interested in target firm characteristic, but indeed is the engagement structure. We are trying to understand even what would be the most effective way for if you want to have a coordinated engagement to engage with target firm. What would be the most effective way, and what would you do to attract different type of investors and to make the engagement successful? So indeed, it's a correlation characteristic that is most important. It is a great suggestion to look at spillover effect. We haven't thought so. So we only look at the bellwether firms, but of course, that would be very interesting to see what would be the spillover effect, because as you say, PRI engagement is the most, well, probably there would be a lot of media coverage, and they are targeting bellwether firms, would be definitely see whether they actually have some some externality of because that's the actual target of what they are doing is they target bellwether firms in order to have some externality of the whole industry and the whole country. That would be very interesting to know as well. So as you suggested, it shouldn't be too difficult to compile the data. And so the differences in target before engagement. So we did look at that. We look at what type of firms are likely to be targeted in the first analysis. So indeed, they are quite different. So we thought about matching them, but we cannot really match because every firm, pretty much every firm, is the biggest one from their country and their industry. So it is very difficult to find matching. Usually find from the peers from the same country and the same industry, but they are all the leaders of their respective country and industry. So it's impossible to find anybody that's even close to them from the same country and industry. But we did look at their characteristics when we look at probability of targeting. But we should have mentioned it. You made a good point. We could have mentioned about the trend and their behavior, the characteristics before being engaged. And external validity, yes. You're right that data was given by PRI, and initially this project was commissioned by PRI of doing that. Therefore, we are focusing on PRI. And at that time, when we started the project back in 2015-16, there were not that many coalitions available, especially focusing on the environmental, social issues. But nowadays, there are many. But with the difficulty of comparing with them is there's literally no literature, no evidence on how those other coalition works. We would love to know, but there's only one paper that is published in Journal of Corporate Finance looking at the Canadian Good Corporate Governance coalition. That is focusing on the corporate governance issue, but not the social environmental issue. But we could refer to that study more and compare the success rate with that study. Yes.
Sorry, we're running out of time. If you can very quickly comment on why coalitions that are led by a founding PRI member are less successful. That was one of the questions in the Q&A.
That is a great question. Actually, I just asked myself 10 minutes before the presentation. That we haven't found the answer. I think we'll probably need to give a PRI a call after this conference, ask them why PRI funding signatories actually lead to lower success. But at this point, we don't really have an answer for that question. But it's a very good question.
Very much to all the presenters and the discussant. This is certainly a very interesting session, and I'd like to conclude now to give time for a break before the next session. And yeah, so we'll have a 10-minute break. And if anyone else have questions, you can maybe communicate directly with the authors or the discussants. Thank you very much.
All right, so let's formally kickstart. Welcome back, everyone, to the IWFSAS conference. And I know what you're all thinking, what a great acronym, rolls right off the tongue and fits perfectly with the ever-growing library of acronyms within the ESG, CSR, SRI, RI, TCFD, NFDR, GRI, SASB, GRESB space. So in addition to that, this is our last paper session today. So by default, best for last. In addition to that guaranteeing excellence in the session, we do have two very interesting papers here, quite on very different topics on physical risks as well as shareholder activism. And I just wanted to add my 2 cents on why I'm looking forward to this next paper, because when it comes to activism space, demand is growing and the actors involved are increasing, and especially the proxy voting arena, it changes every year. So I look forward to kind of hearing more on the evolution of this space, because it has brought a lot of confusion depending on the stakeholder or audience member. But what I also wanted to mention was that it's unfortunately becoming politically sensitive as well when it comes to the US, the current administration within the US. Both the Department of Labor and the SEC are now actually putting a lot of obstacles in place for this democratic process within the financial intermediation chain. So if either of those proposals pass, that's going to make it much more difficult for institutional investors to vote on these environmental and social issues, and potentially even much more difficult to file resolutions in the first place. So thank you and welcome, Ivan, for joining us here today. Rules of the game,
Okay.
you have 30 minutes, and in case we're running close to overtime, I'll give you a 1-minute warning. So thanks again, and the virtual floor is yours.
Okay, thank you very much for that introduction. I'm Ivan Diaz-Rainey. I head up the Climate and Energy Finance Group here at the University of Otago. You said leaving the best till last after seeing the last few papers. I'm certain that isn't the case, and I'd like to emphasize we're still doing a lot of work on this paper. So we're definitely open for comments. The paper came about because, in fact, Antonio Mateo Marques, University of Seville, visited us here in New Zealand last year. So he's a PhD student at the University of Seville and spent 3 or 4 months here working on this project just to sort of diversify his experience. And so it involves his supervisor, Constancio Zamora Ramirez, and also another colleague here, David Lant, and Paul Griffiths at UC Davis. So the paper follows on nicely from Z's presentation, and so shareholder UNPRI. She gave an excellent introduction to UNPRI and what it is, and one of the key tenets of UNPRI is to be active owners, and the sort of engagement that she was showing is the sort of more informal end of the engagement that's going on around ESG issues. Well, in this case, we're looking at the more formal process that shareholders can enter in terms of getting companies to change, and it's a lot more focused on one particular area, and that would be climate change. So when I put CC up there, I mean climate change. So it's part of this whole area of engagement. There's various different levels, and this is the sort of more formal route. Of course, the other option is divestment, but for most large institutional investors, full divestment is not really much of a not really an option, right? Since they're tracking indices and so on. Climate change shareholder proposals have become a really hot topic, as you intimated, and it's interesting that the current administration is trying to make things more difficult. I think you might be interested in one of our results, so maybe it hints that informally it's had that effect already in terms of allowing resolutions to go forward. I'd be curious to see what comments people have on that. In terms of there's quite a big growing literature on the effect of focused on ESG and SRI around shareholder resolutions. There's an even larger literature around shareholder activism more generally. But what we try to do is look at climate change related shareholder resolutions, and really specifically focused on climate change. There's fewer papers. I was at the Grassroots conference last night, and Caroline Flammer, I think from Boston, I think that they're doing some work in this area as well. So there's now some more working papers, but it's an evolving area. So our focus is on how these climate change shareholder resolutions have changed, and so when we talk about evolution, I guess we mean, well, these resolutions can be either omitted, they can be withdrawn, or they can go to vote. And when they go to vote, they can either be passed by a majority, or they fail to get the majority that they need. So there's a number of possible outcomes that can happen. And so these distinctions haven't really been made clearly in terms of climate change resolutions, and actually from what I can tell from the literature, hasn't been explored too deeply more generally in terms of activism in ESG. We also look to distinguish between what we call disclosure related proposals and risk-related proposals. Maybe risk is not the best word to use in this context. Maybe risks slash strategy. And this is an idea that sort of came from me, and because I saw an evolution that happened in terms of these shareholder proposals. So, when it first, in the early years of this, shareholders said, look, you need to disclose your risks related to climate change. And companies, I guess quite cutely, said, well, we're happy to do that. We're happy to disclose our Scope 1 or Scope 2 emissions, because that's entirely consistent with the idea of cutting costs, right? So, for instance, there's a good example of Suncor. The Canadian tar sand company made it into the FTSE for Good index a few years back. And, one of the reasons they got into the FTSE for Good index was because they were disclosing Scope 1 and Scope 2 emissions. So, companies can be pretty strategic and start disclosing stuff that is kind of in their interest, right? But if you think of an oil and gas company, what really matters is Scope 3 emissions, right? Well, so how their hydrocarbons are burnt and how their business is affected by a carbon constrained world. In other words, sort of the TCFD kind of strategy risk alignment to Paris type. So we try to distinguish between these two. As I intimated at the beginning, we're still doing an awful lot of work on this paper, and we have authors across 3 very different time zones, so coordinating on this paper has not been easy. So there's that element of, that's what we mean by evolution. And we also look at the characteristics of target companies. So, yep, and that's another element. And we also look at the determinants of whether a proposal goes to vote. So we have regressions that have coded one that the proposal goes to vote and 2 otherwise. And then we also have regressions that look at the vote outcome. Yeah. And finally, we have a typical event study looking at the market reaction around these shareholder proposals. So there's two strands of literature that are relevant here. So we look at, so one of would be at the determinants of shareholder activism. And generally the literature there finds that's the focus, the target firms are larger ones that have poor environmental and social performance and have lower levels of operating performance. So, hinting that shareholders are unhappy with them just out of pure performance metrics. There's also on the market response, various studies looking at how activism very generally has affected market response, and there's a mixture of studies that have positive and negative effects. Generally, the literature tends to find a positive effect around shareholder activism generally, and often in terms of ESG subsamples, the evidence is, well, again, mixed. Some find a positive effect, some find an insignificant effect, and I guess you need to decompose the E and the S and the G, and again, there's variants that occur throughout the literature. We have Bird and Cooperman, but they find a negative effect, and that's one of the studies that looks specifically at one of the few that looks at climate change. And of course, always with event studies is, when is the market going to first get the information and respond to it, and indeed, are there confounding effects? So could be the date of the initial letters. Quite a lot of these studies also look at media releases. So quite often when you have these activist investors, they're not shy about it. They press release the fact that they are putting in a shareholder proposal. And so there's that date, there's a proxy filing date, and then there's obviously the AGM date. But the AGM date is is highly problematic because, of course, so much is going on, and trying to unpick what is driving any AGM result is difficult. So again, this provides a little schema of and more detail around the possible avenues that shareholder proposal can go. So you have a shareholder, they submit the proposal. It can be they can do it directly, or they could do it via a proxy, and generally it's done via a proxy. And so then the company receives it and has a number of options. So it can disagree and appeal to the SEC under Rule Sec 14A/8 and ask for this proposal to be omitted. So the arguments they can raise here are it's false or misleading statements. They have low relevance. In other words, they affect less than 5% of total assets. They're duplicated, or the company can claim that it's already addressed the issue. The SEC then makes a judgment. They can judge in favor of the company, in which case the resolution is omitted, or they can make a judgment against them, and then it goes to vote. The company can just agree to the resolution and allow it to go to vote. And so I guess one of my hypotheses or our hypotheses around this distinction between disclosure and risk-related proposals is that with the disclosure ones, generally companies realize that it's in their interest to disclose more, and if it's around stuff like scope 1 and scope 2 emissions, as I said, it's very congruent with reducing costs, so they're likely to let it go down that path. But proposals that are more fundamental, and I guess Exxon is a good example here, where shareholders may be asking, well, how does your strategy align with keeping temperatures below 1.5 degrees or 2 degrees as outlined in the Paris Agreement? What are your risks of stranded assets? And then in this case, it's what are you doing strategically? How are you altering your strategy? Then in these more difficult ones, the company might react by potentially, well, they probably try and push it towards the SEC, or they could try and negotiate in a sort of intermediate resolution. So I guess the ones that they really don't like, they'll try to push down this end of the tree. The ones that they are quite happy to go down here, and the ones where I think that they think there's scope for negotiation go down this bottom branch. And if negotiation is unsuccessful, it goes to vote, and if it is successful, then both parties agree and a no action letter is issued, and that gives us another relevant date for our event study. This is an example of a timeline of a proposal. It's in the paper. I won't go into too many details, but the deadline for filing one, and this is related to Exxon, and it's as you sow. I'm sure many of you have heard of this. This is an NGO very active in the space, and as you sow submitted one on the 13th of December 2016, just before the December 15th deadline, and then on January 23rd the definitive proxy material is filed. Sorry, actually, so sorry, the Exxon tried to have it omitted, so they go down this path, but the SEC obviously doesn't rule in their favor, and it ultimately goes to vote. Okay, so methodology, so the data. So we're looking at climate change related shareholder proposals for US companies. The period is 2009 and 2018, and the data comes from CEPR proposal, again another important NGO that is playing a critical role in this. From that, we get a sample of 717 proposals that target 274 companies. And again, it's a relatively small number of companies that are being targeted. Again, consistent with the prior presentation, that it's those sort of blue chip companies that are getting the greatest level of attention. The data comes from CETIS, from Direct Edgar, we get the DEF 14A and AGM dates. We go to the SEC website to get those no action letters that I mentioned when there's negotiation between the company and the shareholders, and then standard sources for the other variables. These are our models. So for the evolution, really it's a largely descriptive analysis. And at the moment, so when I make this distinction between risk and so the more risk strategy type resolutions and disclosure ones, at the moment it's a purely quantitative approach in terms of word counts, and we've been doing some checking on this, and there's some miscoding there, so we're having to look at that. So I would say I would add a caveat then, the distinction between risk and disclosure that we make, probably it needs quite a bit more work. In terms of the characteristics of targets, so we have the dummy there. One, if it's a target, we have pretty standard controls in there to explore what are these characteristics. The determinants of whether the proposal goes to vote. So does it go to vote? Again, it's a dummy variable, and then we rerun this regression with the actual outcome of the vote, the percentage outcome of the vote. And and something's gone wrong with my equation there. There's an equal sign that shouldn't be there. Apologies about that. In there we have post-Paris and US withdrawal from Paris, and there we have our standard event study. And here's an example of how we would sort of try to get to the distinction between what I would call a disclosure type resolution to a more sort of fundamental one, looking at sort of planning and business strategies. So staying within 2 degrees Celsius. So just a much more profound type of resolution. And as I said, one of the reasons I'm interested in this distinction is because I've seen these coming in, and I've seen them, that companies tend to find them more difficult, and indeed our results would suggest that would be the case. But as I said, we're having some issues around coding that distinction. So here we have the number of proposals, which have clearly been growing up to 2016, and there's a slight decline 2017, 2018. The sort of reddish ones are the disclosure related ones, and the risk related ones appear to be growing. And this is the average percentage vote. So we're seeing that the average vote, and interestingly, after Paris, there seems to be a sort of a break there, a structural break, where the average vote is increasing, the vote outcome. These proposals are getting more votes. So the number of omitted proposals, so remember that's when the company tries to get the proposal omitted by the SEC. There isn't really much of a difference between risk and disclosure related, but to the degree that we are capturing something meaningful in this distinction, there would seem to be a big difference between disclosure and risk related. So with the disclosure, they're often withdrawn, which suggests that the company and the shareholder bringing the resolution negotiate and find a resolution. Whereas the more risk ones, I interpret this as, and sorry, because the paper doesn't really interpret it necessarily quite this way, and I interpret this as the companies find it harder, and ultimately it goes to vote. And in fact, it may first try to get omitted, and then it eventually comes to vote. So here are the characteristics of the target companies. So I guess nothing terribly surprising here. So we have this column which has the whole sample, the risk-related ones, and the disclosure ones. The size, so bigger companies are more likely to be targeted. Lower book-to-market companies are more likely to be targeted, and lower sales growth companies are likely to be targeted. Lower dividend-paying companies are much more so dividend yield is highly affected, highly significant. Cash flow, so higher cash flow, more likely to be targeted, and capex, they seem to be higher capex and lower R&D type companies. But again, some of these don't go across both models. But really, they're bigger firms. They have lower sales growth, are the ones that seem to be really robust, and lower dividend yield. And then looking at the determinants of whether the proposal goes to vote. So again, this is one. Does the proposal go to vote, and 0 otherwise? And so size and the whole sample seems to be important. Book to market seems to go in the other direction as before. But I guess given your comments at the beginning, Mikael, US withdrawal from the Paris Agreement seems to have a negative effect there, and so that's interesting. So yes, it's less likely to go to vote after the US. So I don't know. You know, this is regression. You know, I don't want to overinterpret the results, but you know, given your comments at the beginning, this result would seem to be consistent with the idea that, you know, post Paris, maybe the SEC felt more empowered to omit ones, or maybe shareholders felt like they had it. They were more likely, they needed to negotiate more with the firms. I'm not sure. But what really is quite evident is that a lot of these proposals get repeated or amended slightly. So you see that in the data set. They come in year after year. So there's that persistence, right? And clearly that persistence ultimately pays off, right? So, you know, if As You Sow puts in a resolution and they don't succeed 1 year, they'll keep trying. They'll keep knocking at the door, and ultimately that affects success. Then we have determinants of voting outcome. Actually, not too much here, but actually, interestingly, post Paris, it's more significant, right? So I'm not really too sure how to. Or I don't want to overinterpret the US withdrawal, this negative effect, but I mean, we do have year fix effects, and we did see that voting in the descriptive clearly going up after 15. So it suggests that, you know, shareholders perhaps, or I mean, it may not just be Paris, right? But it could be a confluence of events that were happening around 2015 and thereafter. So, you know, we have year dummies that should capture yearly changes, but this captures post 2015. Suggests that shareholders are more likely to vote in favor of climate change resolutions thereafter. In terms of the stock market event study, so you have the event date, the -1, +1, and a sort of capturing a leakage type effect, and then an extended window post, which is +10. And what we find is, in terms of there's a proxy statement filing date, the annual shareholder meeting, but you know, there's so much going on there that date is problematic, and in any event, it's not showing any significance. The no action letter, that's again when the shareholders and the companies agree to withdraw the resolution doesn't have to affect, but the proxy statement filing does appear to have an effect. And it would seem to be positive when those proxy statements have shareholder resolutions, and some suggestion there of information leakage, but obviously an effect in the longer window. So there would seem to be an effect. I'm not showing that here, but when you look at the breakdown, actually this result seems to be driven by our risk resolutions. So, and as I said, that's driven by a search term on DirectEdgar, on that DirectEdgar data that sort of counts certain keywords like risk, like 2 degrees and so on. But as I said, I think we want to tighten that up with a sort of qualitative assessment with that. So to conclude, risk-based proposals are more likely to receive shareholder votes, whereas disclosure-related proposals are more likely to be withdrawn. And so my conjecture is, and we clearly, because as you've read the paper, probably have quite a discussion around this in the team. And yeah, I said that I apologize, the write-up of the paper needs quite a bit of work. But I interpret that these risk ones, to the degree that we are capturing risk in terms of strategy and more fundamental proposals, companies find hard, and therefore they don't negotiate, and they go to vote. Firms targeted by climate-related proposals are larger and grow more slowly. Proposals repeated in consecutive years are more likely to succeed. So there's that persistence effect, and it would seem that Paris, or the period post 2015, captures some momentum that is going on around this sort of issue, and the market reacts positively to climate change shareholder proposals based on that proxy filing date. And that's it. I look forward to your comments, and thank you very much for having this paper in the agenda.
Thank you so much, Ivan. That was spot on in terms of timing. So personal thank you as well. You're making my life very easy at the moment. I want to mention that I think there's a lot of things there that was interesting, but especially the fact that in your paper you really show that the proxy voting landscape is much more than what it is once it reaches the vote. I think that's really where I thought it adds a lot of value to current discussions, because it's another arena that I think we don't discuss as often. Next, I would like to invite Vikas Mehrotra, our discussant.
Thank you very much. Let me put the screen on here. So again, it's a pleasure to discuss this paper. I really learned new stuff. So my comments, I'm going to start with the broad contours of what is going on here. This is essentially institutional investors who get money from their clients, and then they have to put this money to work, which goes in the investee firms. And then in turn, the clients want to know what is going on with their money. And so in that regard, what clients want is more disclosure. What these institutional investors then want is for the firms to tell them what kind of risk the money is being put to. In particular, in the context of this paper, it is more about how climate risk affects what firms are doing, how firms are planning to deal with the increasing onset of climate risk. So firms then need to both come up with a plan for dealing with climate risk, and institutional investors in turn need to come up with a way to disclose these plans to their clients. On top of this, you have institutional advisory companies like ISS, who might also interject themselves in this process, nudging the behavior of institutional investors one way or the other. So climate change shareholder resolutions, the paper broadly looks at two aspects of this, the determinants and the consequences of these resolutions. On the determinant side, we have a fair bit of work in this study on the target characteristics. And to cut the story short, we find the targets tend to be large, they tend to be poorly governed, and they tend to sort of have a need for reputation. On the sponsor side, the people who do bring the resolutions, we would want to know a bit more. So maybe at the expense of adding a table, maybe we could learn a bit more about what the characteristics of the institutions who bring these resolutions are. Are they pension funds? Are they activist funds? Who are they? Consequences. The main area of looking at consequences here is the issue of shareholder welfare. And here, I'm sort of torn here to see how exactly do we measure shareholder welfare in the context of socially responsible investing. And I'll come back to this. So the climate change resolutions, according to this study, come in two sort of broad flavors. They could be disclosure types, where shareholders want greater specificity regarding what the company is doing regarding climate risk. And then the climate risk types, where the institutions want to know from the firm, tell me your plan A and plan B if climate event 1 happens, etc. So this is again going back to what we had here. We have firms sort of engulfed in this broader climate risk environment, providing risk mitigation plans to institutional investors if climate event of certain types happen, and then the institutional investors passing that information on in the form of greater disclosure to their clients. So disclosure and these risk plans sort of go together. A key finding in this paper is that disclosure-related proposals are more likely to be withdrawn. The study concludes that this suggests that firms view disclosure-based proposals as costlier than risk-based proposals. Now that is entirely possible, but I would submit there's another possibility. Could it be that disclosure-based proposals are more easily worked out in private with the clients and therefore withdrawn? For most firms, the issue of climate change is usually framed in terms of how they ought to respond to this. That depends, again, to a very large extent on what investors want. And here, I would submit to you to look into the catering theory advanced by, among other people, Baker and Wurgler. And the catering theory essentially says when investors demand greater disclosure, firms that oblige are going to be valued higher. At the margin, the last firm that sort of engages in disclosure is going to find that its marginal cost and benefit equate at that margin. In equilibrium, therefore, there ought to be little incentive for the marginal plus one firm to sort of join this disclosure group then. Climate change and risk, that is a different story. This is not about catering to investor whimsy and so on. Is it possible that disregarding risk mitigation-based proposal carries a higher litigation risk, and therefore firms tend to fast track this one? Now, I said I promise you I'm going to come back to shareholder welfare. How do you measure this in the context of socially responsible investing? So the question is, what do shareholders care about? What does a lack of a positive stock price reaction tell us, or for that matter, a significant positive stock price reaction tell us? Who exactly is the marginal shareholder here? Who is the resolution sponsor? And here I would like to sort of briefly bring to you this little figure that I have drawn here. And this is shareholder utility based on two arguments. One is consumption of climate. That's on the vertical axis, and the horizontal axis is what we usually teach our business students, that shareholders care about returns. Now, if they only cared about returns, all of this talk would be moot. So clearly they do, at least the new species of shareholders does care about climate. Mm-hmm. So in that sense, we have two arguments now in shareholder utility. And that's something to keep in mind, that only one of these, namely the horizontal axis, shows up when you measure impact of event returns on using share prices. The shareholder consumption of climate does not show up there. So what is new in this study? Some of the stuff we know from other studies. For example, one of the papers that is cited in the study is by Dimson, so I had a quick look at that. And there we find similar results as we find in this study, that firms that are targeted tend to be large, mature, poor performance, at least in a relative sense, and they tend to be in industries where reputation is important. And then the other paper that I mentioned here also shows that the chance of a successful engagement rises with the equity held by the fund and by their persistence in pushing that proposal forward. Success prospects for successful engagements, two conditions need to be met. One is that the target must care about the proposal. That's clearly obvious. The second one is targets must be able to afford the change. And here I bring to you some of the regression coefficients that are very significant. They generally tend to be the variables that have price in them. And so the message I get from the regression is that higher price firms get targeted here. What's the story behind that? We would like to know the story behind that. I promise you that we're going to have a quick look at the event study. So one possibility is that successful engagements bring about other changes that shareholders care about, such as transparency and superior governance, as in Dimson and so on. The other possibility is that investors discount the discount rate investors use dips because of their consumption of climate. And this is the second argument in the shareholder utility that I mentioned earlier. And there's a positive market reaction based on a lower discount rate. So I'm going to just quickly, I know I'm running out of time here, so quickly mention to you the old peeve that Mr. Friedman had with CSI initiatives is that if these are good for the firm, they will be adopted on their own. If not, why are we compelling firms to do so? So when I see a positive stock price reaction to successful engagements, I'm a little bit puzzled then. Why weren't these policies in the engagement effort adopted unilaterally by the firms? Is it a case of some sort of contracting frictions or of behavioral biases? And I quote again the Dimson paper, which says, our interpretation is that active ownership attenuates managerial myopia. Something to look into there. So what might generate a positive price reaction to climate change resolutions around the proxy filing date? And here I would recommend refer the readers, the authors to another paper by Benabou and Tirole that looks at CSR impact, and they come up with three possibilities: that CSR aligns management with the long-term view, get a positive impact. CSR represents delegated philanthropy. If the delegator is the marginal investor, once again, the impact is positive. And the last possibility is CSR is managerial philanthropy, sort of an agency cost, and you have a negative impact. So the real question is this: to what extent is these climate initiatives baked in? If it is anything like the sort of the debt and tax models of Modigliani and Miller, one would imagine that that firms have invested in the aggregate just enough in these climate initiatives such that the marginal benefit equals the marginal cost. At this point, the marginal shareholder's welfare is maximized in terms of returns, dollars, and the climate arguments that we mentioned earlier. The next firm that jumps into this climate pool is unwanted or at least unneeded. The shareholding sorting is already done at this point. So I would put the Benabou and Tirol's 1 and 2 expected impacts at 0. Finally, what's going on with the climate, the Paris Agreement?
I'm really sorry to interrupt, but we are close to running out of time.
Okay, so this is going to be my last slide. What else happened on November 4th, 2016? Well, this guy was elected, and so what impact does this have? I would say that fewer proposals get included in the proxy following the election of Mr. Trump, but those that do get more support, is it because of the Paris Agreement, or is it simply a truncation bias? So I'm going to stop here. I really enjoyed the paper, and I would be happy to correspond with the authors if they want to. Thank you so much.
That's fantastic. Yeah, we need to think about that truncation bias. That's a really good point. Would love to hear your ideas of how we might deal with that. In terms of providing more detail on who are bringing forward the resolutions, yeah, absolutely. So we'll definitely bring that. As you probably saw, and I mentioned before, that the write-up is a bit raw, and one of the things that we've been discussing is adding theory. So you've given us a lot of suggestions there. The discussion around changing discount rates and we sort of partly had that, but yeah, I'll ask you for your slides, and you're going to make our life a lot easier. Thank you very much.
Thank you for that. Unfortunately, we are running out of time, but I wanted to ask my quick question for this is, I was curious to hear as to what you've seen by examining these proposals, because what I've seen anecdotally in this arena is that there's massive heterogeneity in terms of the demand on these companies, conditional on the proposal. So some are extremely demanding when pushed by an NGO, and practically might even say if it gets passed, the company is going to go bankrupt. Whereas some of these proposals are quite light touched. So is there anything that you can say about how these differ in terms of the scale of the demand that it imposes on the companies?
I mean, you're right, and I think there's also actually originally in the project we discussed looking at this more. So, I mean, as Vic has suggested, we need more descriptives on looking at who's bringing these forward, but actually would like to go a step further and actually perhaps control for who these different people are and see if that makes a difference. And yes, I mean, and then go on and look at the content. And another idea we have is just to go beyond this disclosure and risk and look at sort of the complexity and that sort of thing. But absolutely, right? If you read some of these proposals from NGOs, you know, some of these firms would have to pack their bags, right? So yeah. Whereas, and there's been this evolution, right? The more institutional investors have probably initially focused more on disclosure and have moved more towards sort of a strategy, but it's a softer approach than some of the NGOs have brought forward. And I think you've seen that. I mean, anecdotally, you've seen that when it's the large institutional investors bringing it forward, it's a sort of more nuanced, more slower approach, and then ultimately they get passed, right, because of these large institutions.
I want to mention to the audience, if they have any follow-up questions, please email the authors directly, because I know I will, and I will be sending a lot of questions your way after the seminar. So taking this moment to just say thank you so much, Ivan and Vikas. When it comes to our...
Thank you, Vikas, and I'll be emailing you.
Sounds good.
When it comes to our next presentation, I did want to mention a personal note there as well, that we'll have Hannes Bohm next, and I actually saw his presentation a few weeks ago, and honestly, personally, looking forward to seeing this presentation again. I know quite often people say that. I don't think they mean it, but in this case, it really is a good paper. It was a good identification. So in addition to just being generally interesting, he is examining creditworthiness of emerging markets, and based on my experience also now at the PRI, you see there's a massive demand from institutional investors to understand E and S risks, both for firms, but also for the sovereigns as well, because the implications of ENS, the structural issues, are completely different and on a whole different scale for these economies. So looking forward, and welcome.
Yeah, thank you for having me, and thank you for the kind words. Can you hear me and see my screen?
All great, thank you.
Cool, thanks. Yeah, so my name is Hannes Böhm. I'm with the Halle Institute for Economic Research, and this is a paper on the physical climate change risks and the sovereign creditworthiness of emerging economies. So to motivate the paper, let me start by summarizing the situation on global warming as it is now. As you probably know, human activities have caused roughly an increase in temperatures of 1 degree Celsius so far, according to the IPCC, compared with pre-industrial times. Now we know that with more warming, we will see more extreme weather events, rising sea levels, but also in general risks to our livelihoods and to our economic prosperity. Still, the IPCC also points out that even with the warming of 1 degree so far, we have already seen more extreme weather events and economic damages. So climate change is not something that will come in the next decades or so. It's already occurring, and we also are already seeing the consequences. And what a lot of regulatory bodies point out is that emerging economies are particularly vulnerable to these consequences of climate change. So let me show you a figure that basically sums up my research approach. So what you see here in the blue line is the average temperature of the 54 emerging economies that are in my panel from 1901 to 2020. And you see that temperatures have started to increase at the end of the 20th century. Yeah, so this is the global warming the IPCC is talking about. And what I basically exploit here is the difference between observed temperatures and the historic temperature average that we've seen from 1901 to 1950, so before the major part of global warming has set in. So this is kind of a measure, a proxy for the degree of climate change we have seen so far. And if that sounds familiar, that is a very similar measure than the first paper we saw today has also used. And another thing is similar because the economic consequences of this temperature increase that I will be investigating concern sovereign creditworthiness and sovereign risk. So that is what the second paper today was also talking about. So I think I would also have fitted into that session. So the argument is that when emerging economies face more natural disasters or other damages from climate change, then their cost for sovereign debt might increase. Several agencies point out to this channel. For instance, the Bank of England says in their climate report that the increasing frequency of severe weather events could have implications for the market price of sovereign debt, those countries most susceptible to it. Yeah, and different agencies have similar remarks. Now let me underline that sovereign creditworthiness is something that is just very crucial for all governments. That's why it's worth investigating. And because any dollar you have to spend on your debt costs is a dollar you can spend on other expenditures that you may wish to pursue. And if it is really the case that climate change could threaten that sustainability of countries, then it's worth knowing about it. So this is then my contribution of my paper. It is one of the first papers that investigates the effects of temperature increases of physical climate change risks on the sovereign creditworthiness of emerging economies. And in the second step, I want to uncover the climate and macroeconomic related drivers of this relationship. Now, so let me give you some background. So most of you probably know that we differentiate between physical climate risks and transition risks. Now, physical risks, here this is from a Bank of England paper, they are risks that that are observable, that we can measure. Yeah, so think about a flood that causes a lot of damages to properties and so on. And in contrast to this is transition risk. This is more of an expectation channel. Yeah, so you have a portfolio of fossil fuel assets that loses in value over time. So it's more of a forward-looking thing. And yeah, to be brief here, I'm more on the physical side of the risk spectrum. So the temperature variation I capture is more in line with observed damages, for instance, through natural disasters, as I will show in a minute. Let me also give you some background on the literature on temperature and the macroeconomy. One important paper that was also quoted today is by Dell and others, who show that increasing temperature leads to lower GDP growth in poorer countries. And Burke and others find that this temperature effect is actually non-linear. So it's countries that are already warm on average that suffer more from an additional hotter year than milder tempered countries. Now, what could be the microchannels behind these effects? Here is where papers like Zhang and others come in, and they show that that in regions with more hot days in a given year, local firms, local Chinese firms in that case, have lower output and total factor productivity compared to firms in other regions. And this is something that several papers find. Yeah, so firms obviously become less productive the warmer the weather gets, and we can actually see these effects. They are non-negligible in that sense. Still, there are also political consequences of rising temperatures. So Zhang and others find in their review article that warmer weather leads to more interpersonal conflict, but it can also lead to riots, political instability. And for my paper, it's, I guess, intuitive to assume that political instability is bad for sovereign creditworthiness. Of course, temperature and agriculture are related. So I will also be investigating how economies that are specialized in agriculture, how they fare with warmer weather. And since I'll be looking at a financial market variable, it's also good to know that Van Zaal and others find that temperature variation is actually priced in financial markets. So they find that several US equity portfolios have a negative beta, a negative exposure to temperature fluctuations. And this is a graph that shows the connection between temperature and natural disasters. So the dashed line is once again average temperature of the panel countries, just like in the beginning. But the lines with color are the occurrence of natural disasters, of climate-related natural disasters of these same panel countries. And you see that there's something like a positive correlation between temperature and more natural disasters. Of course, that's partially driven because we were just not as well adapted in discovering disasters back in 1920 or so. So I admit that's partially because of better detection. But again, it's intuitive to assume that natural disasters become more frequent with climate change and that they cause economic damages that are bad for sovereign creditworthiness. Okay, let's get to my regression specification. I estimate what some call the new approach. So I regress sovereign creditworthiness on temperature anomalies plus controls. I get to in a minute what these temperature anomalies are. For now, it's good to know that I have monthly frequency data. So my panel runs from 1994 to 2018. It consists of 54 countries in an unbalanced panel. I measure sovereign creditworthiness as the log return of the emerging market bond index. So this is a common measure for sovereign debt performance of emerging countries because countries have to fulfill certain requirements to be included in the MB. Debt has to be dollar denominated, has to be liquid enough. So that makes it very comparable across countries. I also control for precipitation on the country level, and I include country and region times month year fixed effects to make sure that all the temperature variation is idiosyncratic and not driven by common phenomena that affect all countries. I don't include any further controls on the country level that you might think of in such a regression, for instance, stock returns. This is because the literature has a strong stance against over-controlling with variables that are themselves endogenous to temperature. And since these are extremely well-published papers, I'm inclined to follow here the leading literature and don't include any further country-specific controls. My temperature data comes from the Climatic Research Unit, and let me show you now what I use as temperature anomalies. So I start by using what I showed you in that first graph, just the simple difference between observed temperature and the historic temperature average of a country, so that current temperature is compared to that average of that month in that country. And again, this is kind of a proxy for so far observed climate change and extreme weather events. Now I have one more version of this. I call it deviation adjusted temperature anomaly. And here I just divide this standard temperature anomaly measure by a country's standard deviation of monthly temperature. Yeah, so this kind of puts the temperature shock into comparison if the country has a very strong seasonality, if it has warm summers and cold winters, or if temperature is roughly constant throughout the whole year. And I have the hypothesis that higher temperature anomalies, based on the literature I showed you, lead to lower sovereign creditworthiness, so that we would expect a negative beta coefficient. Okay, this is a colorful map with the panel countries and their region classification. And here are some summary statistics. So what is important to know is that the temperature anomaly measure that I use has a mean of 0.84 degrees Celsius. And this is reassuring because it's very close to the 1 degree of total temperature increase the IPCC has estimated. So yeah, I'm really capturing what I want, namely the temperature increase we have seen so far. Also, I report here the mean of this temperature anomaly during natural disasters that are climate related. So again, the full sample mean is 0.84, but you see that it's much higher during any natural disasters that are related to heat, like wildfires, heat waves, droughts. Then the temperature increase is stronger, obviously, and it's much lower during cold waves or severe winters. So this is what we would expect. Here I show the mean of an economic variable, for instance, stock market returns that are available for 38 countries only. And I see how that mean changes during times when temperature is very high. So here above the 75th percentile. And you see that the mean of stock returns in these months is much lower. And here you see the mean of stock returns when temperature is low, below the 25th percentile. And then stock returns are much higher. And this is similar for the other economic variables like government primary surpluses or GDP. In a way that we would expect. That historical temperature anomalies, they enter negatively significant when I include the full set of controls and fixed effects. Now, this may not be surprising. For instance, the Beata and others also have an insignificant baseline. It's rather the susceptible that are affected by temperature increases. And it's very similar in my paper. So here, by looking at the variable of deviation adjusted temperature anomaly, again, where I just divide my normal anomaly measure with temperature standard deviation, I get a negative and statistically highly significant effect through the board. And this tells us already that temperature shocks matter, in particular for those countries that have a very low standard deviation, yeah, so where temperature is roughly constant throughout the whole year. And this is what I want to spend the rest of the presentation on, to dig deeper into these channels, which countries are susceptible to temperature shocks. And I do so by looking at several channels that might affect the temperature-sovereign relationship. I go through them one by one. And just for in terms of the method, I either use an interaction model, where I interact with a certain channel to investigate these questions, or I use a bin model. I get to in a minute how that works. It's very intuitive, as you will see. So the first channel I look at is general warmness. So I hypothesize that a temperature shock has a different effect in a warmer month compared to a colder month. Yeah, so if we look at the histogram of average temperature of my panel countries, you see that there's a huge heterogeneity. There are very warm countries, very cold countries. I think the coldest is Russia here. So there's lots of variation. And what I do in this test is I group every country in my panel into one of 5 groups, into one of 5 bins, so to say. And the coldest countries go into the very cold country group, and the warmest countries into the very warm group. With this process, I group according to percentiles, so that it's just data driven, and every group has the same number of countries. One small drawback of this grouping process is that here the warm and the very warm country group are not that distinct. Their average temperature is quite close. So I have a second grouping process where I just group according to 5 degrees Celsius intervals. Yeah. So a country with an average temperature below 10 degrees is very cold. If you have temperature above 25 degrees Celsius, you are very warm, and everything in between. Then of course the groups don't have the same number of countries, but on the other hand, they are very distinct, and the effect should be more clear. And what I do in the following, and where you can see the results in that graph, is I interact every group with the temperature anomaly measure, and see if temperature shocks matter more for certain country groups. As is the case with every bin regression, you have to leave out one group as a base category to avoid multicollinearity. Here I leave out the cold country group, but results are not driven by this. And the important takeaway here is that for very warm countries, I find that temperature increases have a strong negative and statistically significant effect on sovereign creditworthiness. Yeah, so it's the warmest countries that are driving the results that are susceptible to temperature increases. Here results refer to the grouping process of percentiles, but it's similar when I use this 5 degrees Celsius grouping process. Results are even a bit stronger, but again, it's the very warmest countries that are susceptible to further temperature increases. That is also the result of a paper by Burke and others regarding GDP, and so that is well placed in the literature. Okay, let me get to the second channel, seasonality. I believe or hypothesize that temperature shocks have different effects depending how seasonality of the country is. I'm going to be brief here. So I find, again, effects that countries with very low seasonality have strong negative temperature effects on sovereign creditworthiness. But this is also not surprising because seasonality and temperature are very highly correlated. So again, it's a similar group of countries in that sense. Okay, let me get to the third channel, month and season effects. And now here my hypothesis is that a temperature shock has a different effect in summer months compared to winter months. Yeah, so think about a summer that is warmer than average, and that may be very painful because it's so hot and there could be droughts and other things. Whereas a warmer than normal winter might not be so bad because the weather is not that severe. You have lower heating costs and so on. Several channels are possible here. So what I do is I interact every month with a dummy with the temperature measure and see if certain months are somehow special. Here I use May as a base category, but it doesn't matter which base category I use because I find no statistically significant effects that any month, that a temperature shock in a certain month is better or worse than in another. Of course, what I do is, since I have countries both in the northern and southern, adjust the months for countries in the southern hemisphere. Again, that's not one result. It's really just not the case that month effects are driving the shocks. Similar when I do this interaction with seasons. Here leaving out autumn as a base category, but again, doesn't matter. Statistically significant effects allow the conclusion that the temperature shocks are worse in summer than in winter, for instance. Okay, let me get to economic sectors. So here I hypothesize that temperature shocks behave differently in countries that are, for instance, specialized in agriculture or that depend a lot on fossil fuels that may be stranded in a couple of years. So what I do is I interact my temperature measure with first with measures for the agriculture sector. So here I interact with the land share that is devoted to agriculture, with the GDP share, with the employment share. And what we see is that we get the negative sign of the effect that we would expect, that with more agriculture, you're also more susceptible to warmer weather, but it's not statistically significant and quite far from it. And this is also similar when I interact with manufacturing or with industrial employment shares, with service employment shares. And lastly, also with the variable here that is called resource rents. This is the income a country has from fossil fuels, from oil, gas, coal. And again, we have the expected negative sign, but it's not statistically significant. Now, does that imply that countries that have a lot of fossil fuels have nothing to worry about with climate change? I don't think so. I just think that my models, so these temperature effects, they don't capture this issue because the fossil fuel stranded acid is more of a structural thing. It's not related that 1 month was warmer than previously. So I think it's just not the fitting model to detect these effects. Okay, and the last channel I look at is institutions. So here my hypothesis is that institutions can provide something like resilience to temperature shocks. Yeah, so that countries with better governance, they are quicker in responding to a natural disaster, they're better at handling the distributional concerns of climate change, so that this provides adaptive capacities to global warming. And here is what I find. I find very statistically significant effects of the interaction of temperature increases and institutional indices. So for instance, the interaction with the rule of law is strongly positive and statistically significant. If you look at that with a margin plot, you see that the marginal effect of higher temperatures on sovereign creditworthiness is negative if the rule of law index is very low, but with a higher rule of law index, the effect becomes smaller and eventually statistically insignificant. And this is what I find for pretty much all metrics, for civil rights, political rights. Here the index is scaled in the different direction, but the coefficient sign is the correct one. Also, when I look at, for instance, the amount of income redistribution, democratic governments are good, authoritarian governments are bad in that sense. So this is robust evidence in that sense. I also look at climate-related institutions. So here I apply the ND gain index that you've also heard about today in the second presentation, I believe. So this is an institutional index that just captures, that focuses on climate-related institutions. And again, I find a positive effect for the overall index, and mainly it's because the readiness index, the readiness component of the index is driving the results, and not so much the vulnerability component. So in that sense, we see the margin plot. With better climate-related institutions, you have higher adaptive capacities to face temperature increases. Okay, so I showed you a lot of results now. Maybe the question that remains is what matters in the end? Which channels ultimately matter for the research question? And to test this, I first of all introduce a new channel, namely GDP per capita. So here I test or follow the hypothesis if a temperature shock is different in a poorer country compared to a richer country. And I find that indeed in poorer countries, a temperature shock hurts more than in richer countries. Now you might think, okay, but is this not just driven by institutions? So because poorer countries are also the ones that tend to have not so good institutions, and both things may be correlated, and the GDP per capita just picks up the correlation with institutional indices. To test this, I also include the interaction here with the rule of law index as one of the institutional indices, and I find confirmation for this hypothesis. So the GDP per capita interaction becomes small and insignificant, whereas the rule of law interaction stays strong and significant. So it does seem to be the case that institutions are driving this effect. But now you might be wondering, are not also institutions driven by certain things, for instance, climate? Yeah, so there are some papers that suggest that countries with warmer climate zones, they are just not as good in building institutions because of the warm weather. And so my results in terms of warmness could also be related to the results of institutions. So to test this, I first include in that regression my temperature measure where I divide by the standard deviation. Yeah, so this deviation adjusted measure, because it proxies temperature increases in warm countries and countries of low seasonality. What you see is that both the rule of law interaction and the deviation adjusted variable stay significant at the same time. And the same holds true if I include that interaction with the groups, with the bins. So here is the result for the very warm country bin. The other bins are also in that regression that isn't shown here. And again, both the very warm effect continue to hold, but also the institutional effect continues to hold. So it doesn't seem to be the case that you can't build institutions because your climate is too hot, but rather that both the institutional channel and the warmest channel hold simultaneously. And so that with better institutions, you can adapt to increasing temperatures independent or after controlling for your warmness, which is, I think, important for policymakers. Okay, some robustness, maybe what is worth mentioning, I use CDS spreads as an alternative dependent variable. Unfortunately, that's only available for a few countries and not for the full period, but results are broadly intact. I also drop countries that have a large land mass where the temperature average of the whole country just doesn't tell us a lot, and results stay intact. I also do something with the Paris Agreement as a transition shock. I'm not going to go into detail here, but broadly speaking, results remain intact for different specifications. So let me conclude. I tried to convince you that temperature increases that approximate climate change as we have witnessed it so far, lower sovereign bond performance or increase sovereign risk, significantly so for countries that are either warmer on average, that have low seasonality, and that have low institutional quality. But the institutional channel and the warmest channel, they hold simultaneously, so institutions can indeed, according to the results here, provide some resilience to climate change independent of a country's climate. Now, let me talk about the size effects. So I find the strongest effects for the countries that are in this very warm group, average temperature above 25 degrees Celsius. Here I find that the temperature anomaly increased by 1 degree Celsius, so exact the amount we have witnessed so far, leads to lower MB returns in an amount of 12% of the MB standard deviation. And yeah, I'd say this is not non-negligible. And if we assume we're in a 2 degree world, then we are roughly at 25% of MB standard deviation. Of course, then all nonlinear effects, tipping points, and so forth kick in. So that prediction is, of course, to be treated carefully. Still, results imply that climate change can indeed lead to sharply rising borrowing costs, maybe even possible defaults for the countries that are susceptible to it. This has distributional issues because the countries in my panel emitted so far only 36% of total historic CO2 emissions so far, but they pose the majority of the worldwide population. So that means that further policy actions to curb the effects of climate change are called for. Okay, this concludes the talk. Thank you for your attention.
Thank you so much. Not only was it extremely clear, but perfect timing. So thanks again from my side on that one. Now, last but not least of the best for last group, I would like to welcome Michael King to discuss the paper.
Okay, thank you very much, Mikhail, and thank you, Hannes, for the very nice presentation. This is a paper that has a nice addition to what we saw earlier, the paper by John Byrne, which looked at this relationship between cost of debt for sovereigns and climate risk. And what really makes Hannes's paper stand out is that he's really focusing on a channel, and in particular, he's focusing on temperature change. So what he does find is that for the 54 EMEA countries, warm temperatures are bad. They lead to lower returns, which he interprets as worse for sovereign creditworthiness. I'm going to come back to the use of that word later because I don't like the word creditworthiness, and I'll explain why. What you got a sense from his presentation is that he talked about the channels, and I would like to see this a little more clearly explained, but this is effectively what he has in mind. Higher temperatures can either lead to more natural disasters, civil conflict, there's some sort of damage to physical infrastructure or a reduction in productivity or labor supply that reduces GDP growth. And then in his paper, there's not much discussion of the next 2 or 3 parts, which is, well, why does lower GDP growth hurt creditworthiness for all sovereigns, or particularly for EMEA sovereigns in warm countries? Presumably, it's because they have less ability to repay their debt, that their ratings are going to be lower, that their credit spreads are going to widen, something he does touch on later in Robustness. But what we do observe is lower bond returns, or specifically, we observe lower MB index returns. These effects are not the same for all countries, as he explained. They are worse for warmer countries, where those countries that do not have typically a lot of variation in their temperature, what he calls temperature seasonality in the paper, which I found a confusing term because seasonality was also used to mean monthly or a different type of seasonality. But the idea that if you're a country, I presume they must be close to the equator, where you don't have a lot of variation from month to month, these abnormally high temperatures, because there's almost no evidence of abnormally low temperatures, these abnormally high temperatures of about 1 degree, they have an impact. And as he mentioned, he finds this economic significance of 1 degree positive is associated with a lower return of around 40 to 45 basis points, which is economically significant. Also very interesting in his paper, something that he gets to later in the paper, but I think is like the key contribution, is that these countries with better institutions or climate resilience do better. And unfortunately, the paper does not tell us how important that is in terms of the impact on the MB spreads. So as he explained, although we're talking, the paper calls it sovereign creditworthiness, we're really looking at the US dollar index for sovereign bond returns. And it's a nice long sample, monthly data. The right-hand side variable that is mostly of interest has to do with temperature. And as he explained, there's two of them. There's one historical temperature anomaly, which is deviations from the mean. But also a deviation adjusted temperature anomaly, where he basically standardizes this monthly temperature anomaly by country month and by the standard deviation for that country month over this 50-year period. So you can think of it as a little bit like a Sharpe ratio or maybe a measure of idiosyncratic volatility. Panel regressions with fixed effects. And the fixed effects are going to prove to be quite important, particularly the region times month year. And as he mentioned, he's going to look at countries by splitting up by their temperatures in two different ways, using quintiles and 5-degree intervals. And throughout the paper, the results that you have to look for are the ones where he's interacting with either this historical temperature anomaly or this deviation adjusted temperature anomaly. I'm going to refer to them as HDA or DATA here in my next tables. Okay, so quick survey of his results. There are a lot of tables. There's 25 tables. The baseline tables, which he went through quite quickly, show that temperature matters. However, it only matters in the baseline specification with fixed effects for the deviation adjusted temperature anomaly and not for the other one. Take a look at the table. You can see here that when you include in columns 3 and 5, columns 3 and 6, all of the fixed effects, the ones that are going to be used in all the remaining tables, only one of these measures matters. Okay, and that's going to be important because throughout the paper, we're going to see different effects when it comes to interaction. We're going to see that very warm countries work when interacted with temperature anomalies. Also, temperature seasonality when they have low or low seasonality, meaning there's not much variation. And we're not going to see it for other types of countries. But notice here that in these first tables, 9 and 10, there's no interaction with the deviation adjusted temperature anomaly. Starting in tables 11, 12, and 13, he dismisses the month and season effects and the economic sectors. Basically, nothing works. Okay? Notice that in these tables, he's starting to interact with the deviation adjusted temperature anomaly as well as the historical temperature anomaly. Here is where we get to the really interesting results. Institutional quality, climate-related institutional quality. Almost everything is significant, whether it's interacted with either of the two temperature anomalies. The other, in the climate-related institutional, this Notre Dame's gain index, as well as the readiness index, are significant, but only interacted with one of the measures. For example, the Notre Dame measure is not significant when interacted with the deviation adjusted temperature anomaly. So I found these results interesting. I did sort of wonder about data mining. As I read, I felt better, but then I got worse. I obviously want to believe this, so I have confirmation bias. The papers are about temperature. So put temperature right in the title. It is not about creditworthiness. There is no measure of debt. There is no measure of credit ratings. It's really about MB spreads. So it should be about temperature and their impact on MB spreads. The fact that statistical significance is varying whether you're interacting with one of the two measures, I found disappointing. There is no kind of consistent pattern throughout the tables, and I wasn't sure which one I should be paying attention to. So the results did raise a lot of questions, and I think you're going to face a hard time, Hannes, with your referees to kind of rule out alternative hypotheses. The impact of institutions is really what matters. Get to it by table 5. Do not get to it in table 14 to 16. You should also be referring to the papers by Laporta, Lopez, Schleicher, and Vishny. They started this literature in 1999-2000. looking at institutions, but bring this right up front. Why are you not looking at credit ratings or debt to GDP or other measures of creditworthiness? Does a country that's warm near the equator with little variation, does it matter if they have a BBB rating or a single C rating? I would want to know that, particularly as somebody who's interested in credit ratings. You outline a theory, but make sure you clearly say what your testable hypothesis is up front. You do not have to show 200+ regressions. The reality is that most people will only show the ones that are consistent with their story, put the rest in an internet appendix. And my biggest question was, why limit this only to emerging market economies? As we saw in John Byrne's paper, we saw in the papers by Burke and others in Nature, temperature is affecting all countries. These countries have US sovereign spreads or sovereign bond returns. You should be looking at as many countries as possible, looking at the impact of temperature. It'll give you more variation and difference in institutions as well as distance. You did start to look at a different measure of creditworthiness, looking at bond spreads and CDS. You ruled out stock returns, saying that there was not enough evidence or not enough cases, but you could also look at what's the impact on a country's FX, on FDI, on cross-border portfolio flows. If there are really macroeconomic effects, don't just stop at NB spreads. That's, keep going. Does it matter whether you're looking at foreign currency versus domestic debt? All of this debt is US dollar based. Let's look at also what happens with domestic. And why not look directly at disasters as an explanatory variable, as an alternative to temperature? There are databases that show you could look at abnormal natural disasters as an alternative right-hand side variable. My time is done at 10 minutes. I do want to leave you with even some more comments, which you're welcome to follow up later. But thank you for your time, and I look forward to seeing a revision of this paper.
Thank you so much, Michael. Hannes, would you like to take an opportunity to answer some of the comments?
Yeah, thank you, Michael, for the discussion. I really appreciate all the comments. I look forward to reading it in detail so that I have more time to reply. Yeah, basically, I can agree with most of the things. I think it would be more interesting to see certain channels in more detail. It's obviously also something I'm struggling with. Where, how exactly why do we see the effects that we see? What sectors do they affect? What macroeconomic implications does this have? So yeah, it's very appreciated that you laid out all this advice. And yeah, I hope you still like the paper, but I had the impression that I have much to improve on. But in general, thanks for the comments.
Thank you for that. I guess I'll take this as my opportunity to ask you one question, if you don't mind, because I mentioned this previously. Their ESG integration in sovereign debt is becoming more topical for institutional investors, and it has a very different story if you're looking at developed markets or emerging markets. And with emerging markets, not only did you show that your story, at least when it comes to your story, there are massive costs for these economies when it comes to natural disasters, but these are also the economies that need the most financing to tackle the climate crisis. So given Michael's comment, do you have any early insights, or are you planning to actually compare and contrast how these physical risks are at least making this a much more difficult equation? And it's a bit of a big question, I know.
That's really a big picture question. Let me think about this.
I guess to simplify it is simply, have you compared to other papers and seen whether the effects that you're seeing for emerging markets are significantly larger than what they are for established markets?
I mean, that would be the interesting thing. That is, I mean, was also suggested in the discussion to compare the analysis for developed markets, and that's that has been raised to me more often. So I definitely think about including that in the next version. And then we can see, I mean, could be the case that advanced economies are so well adapted that they so far don't suffer from temperature increases. So that would be my hypothesis, at least. But yeah, then I take that as a very strong suggestion to test that in the next version. So thank you.
Okay, no, great to hear. I now must take the opportunity to thank all our presenters. As I said, this was the best for last paper session, so thank you so much, everyone. I was also asked to inform you all, the audience, that please stick around. In 10 minutes, we're starting the public panel discussion. So we're going to have Alyssa Heath from the PRI and Andrea Beltramola from European Commission. So see you all in 10 minutes. Thank you.
Good evening to all. This is the last session of our IWFSAS conference. We had a rich and inspiring 2 days of research papers presentations on climate change, risk and green finance. I encourage all of you to consult our website to see the papers when they are online. Now I start this last climate change and environmental challenges remain undoubtedly a great research area for academics. It's still embryonic, but there is a lot to do to better understand what should be done to tackle climate change matters. And also it is a high policymakers and for international organizations and all economic players, especially financial institutions involved and would like to take the leadership. Now, the adoption of the European Green Deal is the most courageous move at a global level. The decarbonization of the European economy toward the 2050 and would certainly provide to the European Union the leadership in this field. Obviously, there should be some more cooperation on this field, but unfortunately, the Paris targets are not reached, and there are many players, countries, that are not abiding to these climate targets. Now, financial institutions, either domestic institutions or international ones, they have a real role to play to mobilize the necessary resources to tackle climate change and mitigate its effects. They seem to be committed to green transition. But then, of course, it remains to be seen to what extent and what is how long this green transition will stay. Now we have the last hour of our event for this very high-level panel, which will discuss the current thinking and policy actions toward climate change policies, possibly or not in line with the European Green Deal, and responding also to the global challenges. Especially nowadays, we are still living the COVID-19 pandemic, and I assume there are certain interactions with what we're living today. But also we will be looking at the role of financial and investment community and how to accelerate this transition. I'm very honored to welcome our distinguished panelists this evening. Start with Andrea Beltramola, who is a member of the cabinet of Vice President Valdis Dombrovskis of the European Commission, and Alyssa Heath, who is the head of EU and UK policy for the principles for responsible investment. So I would like to give first the floor to Andrea to share with us what the European Union is doing on this specific field. Please, Andrea, you have 10 minutes to introduce your comments, and then we move to the next panelist.
Hello, good afternoon or good evening, and thank you for inviting me to this very topical and very interesting panel. Try to be even briefer than 10 minutes, because I think I prefer to have a debate rather than kind of speaking, you know, solo. I think first of all that we cannot have a discussion on the Green Deal and our climate objectives without mentioning the context in which we are operating, because clearly the coronavirus pandemic is the biggest health emergency that most of us have faced in our lifetimes. But still, the challenge of climate change has not gone away. And we've been hearing in the last months some people saying that climate change and the Green Deal had become a sort of luxury topic that we could not deal with anymore because we had other priorities that we needed to deal with. And in true that at the height of the crisis, we had to respond very quickly and very decisively to the socioeconomic impacts of the crisis. But it is disillusional to think that we shouldn't continue to put all our efforts in the fight against climate change and to pursue our objectives under the European Green Deal. In fact, I think it has been made very clear at all levels that our commitment to go climate neutral by 2050 is an ambition that remains very much in place. And as a stepping stone to that objective, we actually want to raise our targets for 2030, and we will come very soon with a plan to get there. And this obviously will require massive investment. As we increase our target for 2030, we will need even more investment than our initial estimate of the additional 260 billion euros per year, because we have a very long list of projects and activities that we need to fund across different sectors. Now, it's clear that wherever possible, we want the growth that we need to generate to be green. So as you know, we have a very ambitious recovery plan, what we call the Next Generation EU, which is worth 750 billion euros, which is precisely aiming to help our economy get back on its feet after the crisis. And these 750 billion euros come on top of the 1.1 trillion euros of our multi-annual budget for the next 7 years, meaning that we have a combined firepower of 1.85 trillion euros. The bulk of the recovery plan of the Next Generation EU funding will be to support EU member states in carrying out reforms and investment programs. And these reforms and these investments must be aligned with the EU priorities, including the green and the digital transition. So we want this funding to help member states' economies to be more resilient, but also more sustainable and more inclusive. I would say that in many ways, in a way also to respond to those criticisms that I was mentioning at the beginning, the EU response to the coronavirus pandemic is a balancing act, because on the one hand, we have to caution the immediate impact of the pandemic on people's lives, but on the other hand, we should not lapse back into the pre-crisis state. And in this sense, the green transition should be at the center of our efforts in the economic recovery and should be really an engine for us to create growth and jobs and also to create competitiveness. So I mentioned the public funding, and indeed the public funds can do a lot to address the investment needs that we have, but I think it's equally clear that this public funding will not be enough on their own. So we need the public sector to generate the scale of the investment that we need. In fact, we had already devised before the coronavirus pandemic, the Green Deal investment plan to generate at least 1 trillion euros over the next decade. And as part of this, we had already planned to adopt the sustainable finance strategy. And this remains very much a priority for us because we think that generating private investment remains a key, a fundamental part of our strategy to meet our environmental and climate ambitions. So what are the sustainable finance tools in a nutshell? What do we have in the pipeline? First of all, we have our taxonomy system. So our system of classification of green economic activities. The new rules on this enter into force in July. And we are now very busy preparing the first classification of climate change mitigation and adaptation activities, which we plan to adopt by the end of this year. And this taxonomy of green economic activity will be a very important tool because it will be the basis for many other initiatives, such as green mortgages, eco-labels for retail financial products, and also for an EU green bond standards. And on green bonds in particular, I want to say that we have an ongoing public consultation, so everybody is invited to give their views. Here we really want to find out how the EU and its countries can support and incentivize the development of a large-scale and high-quality green bond market. We are also working on EU non-financial reporting rules, because disclosure of this information, climate and environmental data, for example, is very important for investors' decision on sustainable investment. So we want to improve those rules to encourage the uptake of sustainable finance. And of course, we're doing this in line with other global initiatives. Sorry. Of course, these instruments are very important to guide investors towards reorienting capital flows into sustainable investment. And they're also very important because they can help to align public and private finance towards the green recovery. At the same time, this green transition also needs to be fair and inclusive. And this is why we are working on providing financial support to less advantaged regions and to specific sectors and workers to help them to transition to a more climate neutral economy. So I will just conclude my introductory remarks to say that the financing investment decisions that we are doing now will have a very important impact on greenhouse gas emissions and on how we deal with environmental challenges for the next decades. So it's really important that we seize this opportunity now to do things better. Thank you. I will stop here.
Thank you very much, Andrea. This is very clear. And I see that you are moving even above the target of 2050. So you are really moving with the target 2030, which is down the road. And I think this is quite ambitious. And I hope that not only the public sector that you mentioned will move forward with this strategy, but also the private sector. And I particularly refer to the financial institutions. Now I would like to move to Alisa, who is from PRI, to give us her point of view, since she has also the hat of the EU and the UK. So my question is, how do you see both EU and UK policy on climate change, whether aligned or probably less aligned than when UK was part of the European Union? Please, Alisa, the floor is yours.
Thank you very much. In an earlier exchange, I was asked also to reflect on the role of voluntary organisations like the PRI. So I thought I might spend a moment doing that and then locate that in the broader context of the pandemic recovery and the UK and EU relations. So I thought I might start by introducing the principles for responsible investment. For those of you who don't know us, we are an organisation made of now over 3,000 investors, asset owners, investment managers and service providers from around the world, and with a very large body of those based in Europe and in the UK. And I've been with PRI for 7 years now, and I think in that time we've seen a lot of progress. We've seen terms like responsible investment and sustainable finance move from somewhat niche issues to being very much part of the mainstream, and as we've already heard from our distinguished panelists, part of the political dialogue and the regulatory dialogue. And so that's an extremely welcome development from our perspective. And what I've seen, I think, in recent months, firstly, is an increasing recognition or an increasing focus on not just what investors do in terms of responsible investment, but what the contribution is that they make to a goal such as the Paris Agreement. The Paris Agreement, as we know, explicitly recognizes the role and the contribution of private finance as being necessary to its successful achievement. And since then, within the sustainable finance industry, we've seen a far greater discussion of alignment or contribution type activities. So trying to assess not just what investors do, but how close that is to what's required. And that's something that I think has only accelerated in response to the pandemic. As Andrea said earlier, there have been some people using the pandemic as an opportunity to say that we need to slam the brakes on when it comes to sustainability, to the European Green Deal, to the UK's net zero commitment. But in general, I think investors have been hugely supportive of the concept of the green recovery. They've been hugely supportive of integration of sustainability into short-term bailouts, not necessarily in a punitive way. For example, there has been a discussion in Canada about the possibility of requiring companies that receive bailouts to disclose against the Task Force on Climate-related Financial Disclosures. So less about limiting funds, but more about using the opportunity to encourage greater transparency around climate risk. And then, of course, I think there's great support for the integration of sustainability into medium and long-term stimulus packages, not least because this will increase the number of sustainable investable opportunities, which is always such a valuable thing for investors. As a voluntary organization, one of the sort of prompts I was given for this was whether principles like the PRI go far enough. And I think the answer is clearly not. We're not entirely relying on voluntary organizations, as we've already heard from our panelists today. This is a topic that policymakers and regulators are now actively discussing. And within PRI, while as a voluntary organization, we're working very hard to strengthen the accountability of our members and to develop best practices as investors start to think more and more about the real economy outcomes of investment and the profile of the economy that they are supporting. It's clear that voluntary action can only take us so far. You know, investors will act rationally within a system that doesn't necessarily reward sustainable behaviors, that doesn't adequately price climate risks. And that's why it's so positive to hear from both of our panelists earlier about the action that's being taken by policymakers. And the PRI as an organization very actively supports policy action in these areas, both in terms of advocating for certain policies, advocating for high ambition from the EU Sustainable Finance Action Plan, advocating for a high ambition UK climate roadmap to get to net zero and a good outcome from COP26, but also in a very practical way. We've been very privileged to be part of various collaborative initiatives to develop policy in cooperation with the finance industry. For example, PRI was an observer to the EU's high-level expert group on sustainable finance. We talked earlier about the taxonomy. PRI coordinated some of the work that the technical expert group on sustainable finance did on the taxonomy. And within the UK, we've been very active thinking about climate risk as well. So to sort of locate this in the Green Deal, a couple of key points. I spend quite a lot of my time focusing on European policy at the moment because of the urgency of the discussions around the recovery package and the long-term spending programs. You know, the Green Deal is obviously a very wide and transformative strategy. It's very hard to pin a single point and say we'd like to see it do this, this, and this, because it's obviously a strategy that seeks to address every part of the economy as well as addressing the financing and the governance of climate over time. But a couple of things that we would like to see and that I can say quite clearly. Firstly, investors want certainty around the trajectory to net zero. And so we'd like to see a swift and high ambition agreement on the EU's proposed climate law, one that is binding on all countries to achieve net zero by 2050. We'd like to see a 2030 target of at least 55%, which is the maximum range that the Commission has given itself to work within. We strongly support the proposal to review all existing and future EU laws for their consistency with the Paris Agreement and with the net zero commitment. We strongly support the EU's proposal to establish a trajectory that shows how we get from here to there. That trajectory is going to be a very important tool to understand how aligned investors are with that transition. We'd like to see that brought forward because 2030, when it's currently proposed to start, we think is outside the normal political and investment decision making. And therefore it may be left as an issue for the next lot to deal with, where I'd like to see action being taken now. And finally, we'd like to see some independent governance over the EU's climate progress, similar to the Committee on Climate Change in the UK, which does such a great job of holding the UK government to account for its efforts. And talking more broadly around the multi-annual financial framework and next generation EU, I mean, we very strongly support the EU's commitment to align that whole package with the European Green Deal, with the Paris Agreement, and specifically to avoid significant harm to environmental objectives. And one critical way to do this is something that Andrea has already mentioned, which is the EU taxonomy. The EU is in the process of finalising its own view on what constitutes environmentally sustainable and consistent with its environmental goals. And we think that could be a critical tool in the design, the implementation and the monitoring of those commitments to align the recovery package and the stimulus packages with the Paris Agreement and with net zero by 2050. And finally, of course, we'd love to see a very high ambition sustainable finance strategy that really clearly links Europe's investment needs through to the actions that investors can take, and also recognizes the different levers that investors have at their disposal, such as stewardship, in addition to capital allocation. I wanted to make one final observation before I wrap up, which is on the role of different institutions. And historically, we've seen a bit of a divide between environmental and finance ministries. Often you wouldn't see a very strong connection between the work programs of those two institutions. And I wanted to recognize this is something that increasingly we're seeing being corrected through the creation of these new institutions. So the EU is, I think, shortly going to launch a new body called the Platform on Sustainable Finance, a standing advisory body, which is really helping to create the institutions that we need, or it's one of these first generation of institutions that we really need to make the connection between sustainability and climate policy. So I thought I'd finish on that note. Thank you very much for the opportunity.
Thank you very much, Alisa. I think your comments bring very much the introduction and some of the reactions to probably Andrea. I would like to move to Andrea, asking him, do you think the European Union and the European Commission generally would reach or the expectation of what the market is expecting? I would ask the panelists to switch on their cameras. Yeah, great.
Hello. Yes, I mean, I think this is very much our intention. We think this should be a two-way dialogue in a way. We are not operating in isolation, you know, in our ivory tower. And I think that what Alisa mentioned in terms of the outreach that the Commission has been doing for the past years and months actually has been key to our agenda. And to be honest, we wouldn't be where we are today if it hadn't been for the very productive dialogue and exchanges that we had with regulators, with ministries, with the European Parliament, but also with the financial sector, market participants, NGOs, industry. It has been really a very broad exchange that we had. When we started out with the first Sustainable Finance Action Plan, a couple of years ago, 2.5 years ago, this, I would say, was a nascent but still niche topic. So people were, I mean, there were some visionaries also in financial markets. So people were already talking about it and in the policy community, but I think at the time it was not seen yet as something mainstream. And thanks to those visionaries with which, you know, we had the first dialogue, we started, you know, a movement which is now really incredibly relevant, and we've seen it also during the pandemic and the related financial turmoil, how the funds, for example, that refer to ESG factors have held up so well. I know there are different theories and explanations on why this is the case. But I think this is not a fad, you know, this is not something that, you know, is just passing and it will go away. This will stay, this will gain importance. And this is why I think for the Commission, it's really fundamental to keep getting this feedback. And this is why, by the way, as we set up the sustainable finance platform that Alisa was mentioning, which is a legal requirement that the Commission has, which is set out in the taxonomy regulation, and we are in the process of setting this up. Well, there we will need to have very strong representation of industrial and service sectors, because of course we are creating a list of economic activities with very detailed technical criteria, which they need to give us their input on. We will have NGOs, but we will also have the financial sector, because the financial sector is key to give us feedback on the usability of the criteria that we are designing. So there will have to be this feedback loop where the financial sector tell us, okay, what you are designing, commission, makes sense for us to come with better investment funds, with any kind of new tools and standards for financial products, for bonds, for any other type of product. And we will need, and this will be a question of adjusting also, a bit of trial and error if you want. So I think the dialogue with the market will continue to be key in that respect. And also I think as we move forward with our agenda, we will have to listen very closely, not only to financial market participants, to the intermediaries, but also to the corporates. Because I think it's fair to say that so far in our regulatory agenda, we've been very much focusing, for example, on information disclosures by institutional investors, by investment funds, by asset managers. But for them to get the information that they need to disclose to their end clients, they also need to be able to go to the source of that information. So I think it's also important that we now improve the information that comes directly from the corporates, and that we have a dialogue with them on what is the best way for them to disclose that information to the markets, to the investors, and to the general public.
Yeah, that's very clear. You also mentioned that you are stepping up effort for much more investment to reach the target. Instead of 2050, it will be 2030. So it means that this will come from which budgets? Is it only the money that you mentioned from the European Union, or you are also expecting to have much more involvement of the financial market and also from the private sector? This question is for you, Andrea, and for Alisa.
I think the answer is very simple. It's impossible to meet the investment needs that we have just with public funds. So as I said, we have a 2050 objective of net zero emissions, and the intermediate step is the 2030 objective, which we already have, which is a reduction of 40% emission compared to 1990 level, but which is quickly becoming outdated because this week we will present a new target. And well, it's actually next week, because we are at the end of this week, but next week we will present a new target, which will be between 50 and 55%. I'm not allowed to disclose which is the new target, because this will only be decided after the College of Commissioners take the decision. But I think our intention is certainly to have an ambitious intermediate target. And for that, of course, we will also need to amend the climate law proposal, because the climate law proposal now has a 2030 target, which we want to raise. So yes, we have massive investment needs, which are not for such a long term. It's not for 2050. We already need this increased investment for 2030. So together with this new target, we are also planning how we modify all the existing policies, which under the current let's say policy direction will not allow us to reach the new 2030 target. So we will have to embark as of next year in a very big legislative change of many different legal acts in many different areas, or energy efficiency in buildings, from renewables, from transport, our emission trading scheme, and taxation, state aid guidelines. So it will be a massive legislative, let's say, wave of changes, and the related investment that is needed, which will definitely go beyond what we can put, let's say, from the EU budget, although this is massive, because here we are talking about 30% of the whole EU Recovery Fund and of the whole MFF dedicated to these objectives. So it's massive. But still not enough. And this is why, as I was saying in my introductory remarks, the sustainable finance agenda will be absolutely key, because without the participation of the financial sector, we will not get there.
Yeah, that's very clear. Alisa, what is your position on this? Is the financial sector ready to take part of this large plan?
I think so. I think there are obviously very different perspectives within the financial sector, and I think it's very hard to come to one general position. I would say that in general, anything that can clarify the trajectory, that can clarify the expectations, that can give investors the certainty that they need is incredibly welcome. Another point that I think should be reflected is that the EU taxonomy, which we've been talking about already, although it was originally designed as a tool for investors, if you go back to the original proposals from the EU's high-level expert group and the exchange that was had with experts then, it was always seen as having a wider role and a potential to apply in other areas. And so I think it's increasingly seen as important that while the EU is holding investors to account, it also holds the same standards in its own investment and spending decisions. And so we really strongly welcome, for example, commitments to integrate the EU taxonomy into the methodology for tracking InvestEU and the sustainability funds there. So I think there's a number of different elements here. In terms of how investors are thinking about this, one of the very encouraging signs that we've seen is the number of investors that have voluntarily signed up to align their portfolios with net zero. So PRI is one of the convening organizations supporting the UN Net Zero Asset Owner Alliance. This is a group of investors who have voluntarily committed to align their portfolios and are currently doing very intensive technical work on how you could monitor, manage, and implement that commitment in practice. So I think there are some very encouraging signs. However, I do think that there will always be organizations who will only move when the regulators require them to. And so I think there's both an aspirational side to this, which organizations like the PRI and the UN Asset Owner Alliance can bring, but there also needs to be some action to bring the floor up so that everybody is operating on a level playing field.
Misa mentioned something quite important, actually. It's the emergency response of the COVID did not take into account the climate issues. So in fact, do you think this will be corrected? And if so, how is it going to be in the next few months? So this is for Andrea or
Yeah, I would like to say a few words about that, and I thank you for that question because I think it's a very important one, and I kind of alluded to that in my introductory remarks. I think during the most acute phase of the crisis, our first priority was really to get people and businesses to stay afloat. So it was really important for us to support people's income, to support companies that were really fighting for their existence. And we had to get those funds quickly available as soon as possible and to make sure that they got to those who most needed it in the quickest and most efficient way. And the EU responded very quickly in that respect through different tools, state aid. We also kind of activated the general clause that basically allows member states to spend without temporarily disregarding our fiscal rules. So we activated a lot of different instruments, and at that moment, in this acute phase and in this very short term, it was important, and this was our priority. And I think, people were already getting very concerned about, the possible lasting damage that this could make to our long-term objectives. And I think that's my personal opinion, that maybe these concerns were a bit overblown in the sense that this was really the most acute phase of the crisis. But quickly after, we started to devise our recovery plan. And here, I think, have been very ambitious in integrating our long-term challenges, such as climate change, into the funding. And I think, this was really a strategy that worked well. So immediate support without too many strings attached, but very strong ambition when it comes to the long-term vision. So as I was saying, 30% climate mainstreaming across the multi-annual budget and the recovery plan, do no harm principle for the whole fund. So really to make sure that nothing that we will spend on will be harming the environment, if not, let's say, actively contributing to the objectives. So I think I'm really convinced that this was the best strategy. Short-term, immediate response without, too many strings attached, but for the long-term, very clear, very ambitious response also for the Green Deal objectives.
Thank you. There are a couple of questions in the Q&A from the attendants. One is about the other jurisdictions. So some of the countries, like for example, South Korea, which is apparently now committed to the new Green Deal, Australia, Canada, others. So how they may be trying to catch up with this progressive sustainable finance effort to stimulate a more coordinated international approach. So how do you see this happening? And also another question which is linked to this as well is linked to the EU taxonomy and the external, in fact, dimension of the whole effort. So how do you see more organized and stronger mechanisms to protect the natural ecosystem beyond EU borders? So how do you see all of this together?
Is it for me, the question?
Yes, it is.
Okay, thanks. No, I think that's a very important point because the EU has shown very strong leadership when it comes to fight against climate change, and in particular when it comes to climate finance, but we are not acting in isolation, and we don't even represent, let's say, the majority of emissions. So it's very important that we work also with our international partners in that space. And that's why we have launched an international platform on sustainable finance to scale up the generation of private capital. And so we've launched this platform almost 1 year ago, in October 2019, with a number of jurisdictions from across all continents. So we have Argentina, we have Canada, we have Chile, India, Kenya, Morocco, then China also joined, which I think was a great achievement. And then other countries have been joining in the meantime, both in Europe, in Asia, in Africa. So now we have 14 members, which basically represent half of all greenhouse gas emissions and half of the world population. And precisely the objective of this platform is to provide a forum where policymakers and authorities can exchange kind of ideas and best practice on how to develop these regulatory measures, such as the taxonomy. So we have our own taxonomy, which I think we can say it's probably the most advanced globally, but other countries are also interested in coming up with their own taxonomies and are very interested in what we are doing. So I think it's indeed very promising, this dialogue. I think, as Misa was mentioning, there is the Network for Greening the Financial System, also very successful when it comes to collaboration between central banks. We know that securities regulators are also having a dialogue. So I think it's very important that we have these dialogues going on in different areas. On the other hand, we should also be mindful of the fact that there are some potential competitiveness issues, and also, maybe citizens, for example, in Europe, who are asked also to bear some costs and in the transition. And then they see maybe that others outside of Europe do not do the same, and our companies are put at a competitive disadvantage because of carbon leakage. So I think we also need to think about these issues. And this is why we are reflecting on a carbon border adjustment mechanism that can help to prevent that carbon leakage. But okay, as you know, the EU, it's in the EU's DNA to be open and to play by the rules, world-based rules, and we will continue to push for this dialogue, including the area of sustainable finance.
Thank you. I have really a question which I had in mind since some time. So now, should the carbon intensive transition assets subject to penalizing or penalized regulatory requirements? Elisa?
A very interesting question. I think we'd strongly support fair carbon pricing and the reduction of subsidies in the first instance to make sure that climate risk is adequately priced into, or is adequately considered. When it comes to prudential frameworks, we can see an argument for the integration of sustainability risk, where there's a clear and well understood sustainability risk. I think that's a fairly logical position. And we think that there's some role for example, taxonomies that indicate the harmful activities. These could be a proxy in some cases for those types of risk. We are more concerned about the idea of a so-called green supporting factor, because fundamentally that would be changing the purpose of the entire prudential framework, and we do believe that it should remain committed to risk.
Thank you. My last question, the COP26 in the UK next year, what would you like to see? What would you like to have as an achievement of the COP26? I start with Andrea.
I think we want to see many things in the COP26, and I think that the fact that it had to be postponed is only creating even more expectation from all of us of what will be achieved. But if I have to choose one area which it's closer, let's say, to the work that I'm doing, is that there will be a common agreement between the parties, also on a framework of how sustainable finance tools, but very concrete tools, can help. Because I think that here the issue is that there is not across all the parties a full let's say, awareness that it's not only about public spending, but that there is a huge potential also for private finance to channel the investment we need. And not only in, let's say, the big jurisdictions such as the EU, the UK, or the US, but also in those countries where maybe public funding is not very available, and where really there could be investment opportunities if we do it in the right way, with the right tools, by improving also horizontally in the investment climate and the business climate. So I think if there could be some, let's say, understanding, agreement between all the parties that this could be a game changer, I think that would really be something that I would looking forward to.
Alisa?
I fully support Andrea's point. We'd also like to see the US back at the table and fully committed to the Paris Agreement. And a COP can be a fantastic impetus for the host country to establish commitments that help establish its position as the leader of the negotiations. And so we'd really like to see some very strong implementation around the UK government's net zero commitment.
Okay, with this, I would like to thank very much the panelists for today. I hope your expectations for the COP26 will not be a wishful thinking. It will be really something that will happen, and we will move toward a credible agenda for climate change and decarbonization of our economies. I think we need it, the planet needs it, the society needs it. And I think we need to also think outside the box to find new solutions for acceleration of the decarbonization using nature solutions, nature-based solutions. And I think this is now what the research is trying to do from science, and also the economists are putting together their efforts with the scientists to move this as fast as possible. So nature-based solutions to accelerate climate change targets. I think this is extremely important, and also links to the biodiversity, to really maintain the biodiversity in our planet. So thank you very much again, and I would like to hand over to my dear colleague, Barbara Casso, and I would like also to thank all the team for this great conference. Please, Barbara, the floor is yours.
Thank you, Rim. And let me just thank you all the panelists again, Alice and Andrea. I won't take up too much of your time. I know it's Friday night or Friday lunchtime in some countries. So just let me thank you for this couple of days of very interesting presentations. Thank you to all the presenters, the discussants, the organizing committee, and the local organizing committee. Big thank you to Angela Gallo, Mika Homanen, and Francesco Rodriguez-Tus for assisting me in the organization of this conference. Conference chairs, Rima Yadi, Torsten Beck, and Basma Majerbi. And we really enjoyed listening to all your interesting and important research insights. And we hope to see you in person at some point next year. Take care. Bye.